Hi everyone, welcome to another honeystocks.com weekend analysis, and this one's going to be going out on the 4th of June 2022. I've had a couple of weeks off from the markets. I've been on vacation and I'm back refreshed and of course ready to get into some charts. Now, before I get into the charts, I just want to take the opportunity to thank everybody for the reaching out either via social media, email, etc. Just thanking me for a lot of the content that I've been putting out over the last few weeks. I know that it's helped many of you quite a lot. Now, before I get into the charts, please pause the video, make sure you're comfortable with very important disclaimer. It basically just says that there's not any investment advice. Don't be silly and do all of your own due diligence. I'm also registered with the CMT Association. I'm working my way through my exams, and technical analysis is something that I'm very widely known for in professional circles. But I think the main theme of the questions that I get on a daily, weekly basis is really along the lines of whether or not we are about to reverse and move higher and start the new phase of a bull market, or are we currently in a bit of a bear market rally? There's many factors going into it. We have, of course, inflation going through the roof. We have the inverted yield curve, which would suggest that we're on the cusp of a recession. We've got fear and greed index. We're probably somewhere towards the fear end of things. Certainly the last time I checked we were. And I know for many it's about survival in the current volatile, choppy market that we're being presented with at the moment. Now, my time horizon for my work is generally weeks to months. I like to keep it simple. I think there's many analysts out there that really do overcomplicate things. So I think my work probably will appeal to you if you are quite intelligent and don't like to overcomplicate things, which is the way I do it. I'm not a day trader. I think if you were to sit and have a beer with me, I'd probably describe myself these days as a technical investor with elements of swing trading. My work does apply to most styles. I can go long, I can go short, and I also use options as well. So if you do find value from this, please do hit like and subscribe. It makes a massive difference for the YouTube algorithm, and it helps to get my work out there. So, rather than ramble on, let's dive into some charts and let's see what the market's telling us. Okay, so with the charts, I want to just spend around 5 minutes walking through the broader market indices, the major ones, the S&P 500, the small caps, etc. There's some really interesting data that's presented itself over the last 10 days while I've been on vacation, and this is one of the charts that I shared with our clients last week. Now, we can see that the S&P 500 has pulled back. Now, when we get pullbacks in the market, I like to just add the Fibonacci retracement tool just to highlight potential areas of interest where the market could potentially rebound from. Now, as we can see, this is a market breadth indicator that I've added. Now, the reason I've added the advanced decline ratio in this particular chart is because recently it has provided some valuable data when trying to pick up and identify market bottoms. Now, when we had the correction in September 2018, the advanced decline ratio spiked, which was a signal to say, okay, this might be a risk-on environment. What happened when we got to the bottom of the market crash in 2020, the COVID crash? Again, we got the same spike in the advanced decline ratio. Now, recently it hasn't been as reliable. We had a big fake out quite recently back in February, but last week we had another big spike in the advanced decline ratio. Now, this data in of itself is not the magical tool that will pick up market bottoms, but it is one data point that I like to pay attention to. When we use this data in conjunction with a pullback to a logical level of support, it tells me that that might be an environment where you could potentially potentially look to start layering in some risk to the upside. Now, I think we all understand at the moment the market is incredibly volatile. I touched on that a moment ago. I think you have to be very, very comfortable with the risks in the current environment. I think stock selection is, of course, a massive deal at the moment. I think if you are picking stocks that are moving, 10% a day up or down, it's going to be a highly stressful environment. So a lot of the charts that I have to present today are charts that are really there to try and reduce anxiety, especially when I'm looking at the individual charts and the individual names. But again, with the Dow Jones Industrial Average, it met our upside objective back in November. For those of you that have followed my work for a while, you'll know that I've covered this one. But again, we've pulled back to a logical level of potential support, the AVWAP from the bottom of the market crash in 2020. We've got the Russell 2000. I touched on this one in my last social media analysis a few weeks ago, just highlighting that this is a potential support level for the Russell 2000. And of course, what's happened is a lot of the beaten down areas, the names of the market, they have all ripped higher in the last few weeks. So hopefully you've done pretty well from that. Will it sustain and continue to move higher? We will need to see next week. We had a bit of a bearish reaction in the market today, so Monday will of course be interesting as always. We've got the triple Qs. Again, pulling back, I'm using the Fibonacci retracement tool, pull back to a 50% decline of this whole move. So we'll need to see again how the triple Qs and whether or not we are looking at a bear market rally or a potential bottom in the market. I think, something just to put out there just from my own observations is there's a lot of negativity. We all know the fear and greed index. We're at fear, extreme fear kind of areas. We've got massively rising inflation, which I don't really think helps anybody. I think we've got consumer spending starting to tail off. So I think when we look at things economically, it's not looking too great. So I am constantly looking at charts through the lens of, is this a bear market rally? And from my perspective and what I've been putting to our clients and members over the last few weeks is really just to manage risk appropriately. It really is a week-to-week thing at the moment. But I think the US dollar index is the chart that really is driving everything. We put in a potential failed breakout in the dollar index, but what we can often find with failed breakouts is they are essentially false starts. So what I'm really answering here or asking here is, we know that the US dollar has been a massive headwind for US equities over the last 6 months. And of course, if the US dollar index continues to rally higher, that could be a potential problem for stocks. So, if you are bullish on the market, you want to buy stocks, you probably want to see the US dollar index start to fade away here. If you're bearish on the market, then certainly you would want to see the US dollar index start to rally higher. Now, despite what you may or may not think, after watching, the CNBC and the Bloomberg fearmongers, I have to say I don't have much time for any of their analysts. I just don't see the value in what they do. But I think when we look at things like the Treasury Bond ETF, the 10-year Treasury note yield, my thesis really has been with these two charts as well. The 20-year Treasury Bond ETF has potentially found a bottom here, and certainly a flight to safety. If you want to park your capital and remove yourself from a lot of the volatility, then that might be a place to do it. But of course, we've got the 10-year Treasury note yield starting to move higher again this week. So if this breaks out higher and we of course see the US dollar index rally higher, again, that's going to be an environment where stocks, in my opinion, will probably come under pressure. But within that, there are of course many individual charts that are, got very clear support levels in place technically. I'm about to walk through around 25 of them with you. So I think you can get a pen, bit of paper, and if any of the charts look appealing, please understand that I firmly believe in having a risk management process, whether that is a trailing stop loss or maybe you're using a moving average, whatever your deal is. It's very, very in my opinion, important at the moment just to keep a close eye on positions and not let things run too far to the downside. Of course, if you are an investor, that's a completely different mindset. But certainly with technical investing, technical trading, etc., risk management is absolutely everything. So we're going to kick it off with Microsoft. I think with Microsoft, very, very simple chart. There's nothing fancy about the chart. It's a very basic trend line support level. We have pulled back to a level where you would expect some kind of reversal, buying opportunities to present themselves. I covered this chart a few weeks ago. It has moved higher. Will it continue to move higher? I don't have the answer to that question, but what I do know is that the trend line offers an opportunity to manage risk. So if we start to break lower below this trend line, then of course that would be a problem. Now, this is a chart that was shared and sent out to our clients and members last week. We had a confirmed weekly close on AMD back up above a very clear support level. What we know is with failed moves, we oftentimes get fast moves going in the opposite direction. It was no surprise to me that on Thursday, AMD ripped, I think it was 7-8%. Very happy with it. I have call options in AMD, so see how far it wants to go. But what I do have an ability to do is, of course, manage risk. So if AMD starts to fall away and breaks back lower, if the market is under pressure on Monday, Tuesday, I've got no problems with just exiting the position and not taking any chances. Many requests and questions on Netflix. I think with Netflix it has, of course, been beaten to death. Just as a side note, if you haven't started watching Stranger Things 4, I would highly recommend it. I'm thoroughly enjoying it. And for me, I think it makes a lot of sense when we start to get these bases that are building in good stocks. I think we've got decent fundamentals. Yes, I know that the subscriber growth, I think, which triggered a massive sell-off here post-earnings, was an issue. But certainly if price is going to find a bottom, then this could be a logical starting point. So I probably like this above that 2.9, 2.10 level. But as the chart is saying there, be aware that when we have these rallies from downtrends and breaking out of bases, quite often, very basic tools like simple moving averages can act as resistance to price, and then they continue in their downtrend. So if this does break out, I would be looking at this 250 level as a level of interest that I would want to pay close attention to. Apple, I covered this one a couple of weeks ago. It's done exactly as expected, pulled back to its 38.2 retracement level, and is of course rebounded. We'll see how that one plays out. Thank you to everybody who reached out to me after the tweet that I put out on the 24th of May. I know that many have done incredibly well on this one. As you all know, I do not use the magical hindsight indicator. The Amazon chart, again, I'm just using Fibonacci extension levels of the 2016 declines here, because as we can see, the levels have merit for this particular chart. It's maybe one thing that I get asked quite a lot is, well, if you're using Fibonacci or moving averages, whatever chart it is, every chart is unique. You cannot apply the same tools to every single chart, and I think that's probably where professionals come in, is because we take the time to figure out what levels are respected on each individual chart. The biggest issue I have is, seeing a lot of amateur analysts out there posting to stock twits and Twitter, etc. They have the same indicators on every single chart, thinking that that these levels will automatically be the magical tool for you, and quite honestly, a lot of the charts just look like crap because they've just got millions of lines on the charts, and you can't even see price. But I think with Amazon, pulled back to a logical support level. Now, is it a bear market rally? I don't know, but it has already moved 15-20%. So certainly there's a winning trade there, I think, for most who got in. We've got Nvidia. Again, it has pulled back to a logical level there, $150. We've had the earnings out the way. I covered this one for our clients last weekend, just basically saying bullish above 150. Nvidia has of course been massively under pressure, but it does look like the earnings growth decline that we've seen from the earnings has potentially been baked into price, and obviously this decline, the market is forward looking, as we all know. So yeah, it's no surprise to me to see it rally hard off this logical level. We've got PayPal has now moved back up above its 2020 market crash bottom. Potential mean reversion trade, it would be essentially a short-term trade. I know there's many of you that invest in PayPal and love the company and so forth. I use the company as well, I love it, but certainly it has been beaten to death recently. But if it is going to put in some kind of reversal, then this would be a logical place for that to happen. Micron Technology was downgraded today from one of the investment banks. Now, this is a chart that has been sent out to our clients and members as a high conviction idea. I own Micron Technology, but it's obviously chopping about over the last few weeks, and this $65 level has been a complete rock star. I do have a 50% upside objective on it, but of course we don't know what comes next. So if price does break below these levels, then that would be the signal to get out with complete minimal damage. I've covered the energy names to death over the last few weeks. Certainly the energy ETF has broken out. We've got Williams Cause broken out. I own Williams. And ConocoPhillips has done incredibly well as well. This was actually in the analysis that I put out a few weeks ago as well for social media. And of course, they've done absolutely as expected. The commodity index, again, breaking out of a base. I posted this chart to Twitter today. And again, it's looking like it's wanting to move to higher prices. We've got Dow Inc. I like it above $72. Again, standard base breakout. Thanks again for a few Twitter messages on this one. Covered this tweet on the 26th of May, just highlighting Antero Resources and obviously the natural gas ETF, which has been a massive performer this year, of course, helped with the whole Russia-Ukraine conflict. And it does look like it's breaking out and wants higher prices. Yes, it is going to pull back at some point. Yes, it is going to rally as well. That's what happens with uptrends. They pull back and they move higher. So we'll see how natural gas proceeds from here. But this is the Antero Resources chart. I've been covering this one for our clients since way back at $5. This is one of the charts that I sent out at $10. And it has now hit our $45 objective. I did cover this one a few weeks ago as well. So if it can break out above a level dating back to 2015, I have an upside objective there of around $70. Lam Research, covered this one a few weeks ago as well. $450 has been holding up incredibly well. SoFi, I think we all understand that SoFi is a speculative growth name. I'm asked all the time whether or not I'm picking up bottoms in stocks. Well, back on the 10th of May, when the the chart was massively overdone to the downside. I put this chart out way down here, and of course it has rallied back into its 50-day simple moving average. Now, the reason I wanted to highlight the 50-day simple moving average is because we are once again at this key level for the stock. As the chart can demonstrate, it has been a problem, but if it can break out higher, definitively above that 50-day simple moving average, I suspect those of you that hold SoFi will be quite happy. ARC, I covered this one a few weeks ago. Again, massive support level in place. So I think the next level that we're going to have to pay attention to here is around the $50 level. I think if it can break out above $50, then ARC it could potentially get moving. I think we've got MGNI. Again, purely a mean reversion, short-term opportunity in my opinion. I think it's got a massive PE, and yeah, it's looking like it's putting in a potential base bottom. Will it get back to its all-time high prices? Probably not anytime soon, but it is one of those that could present opportunity. Again, textbook technical analysis. I think I put out a tweet on this one as well, American Express. I think there's a very logical upside target here, very key support level. I think maybe that's something that I think, certainly just from the emails and the messages that I get, I think there's many that don't utilize basic technical analysis of support and resistance. It really is as straightforward as just building in a horizontal line and figuring out what levels the market is respecting. American Express was a chart that put out to our clients a few weeks ago, and of course it's kind of doing its thing. So I'd hope to see some kind of resolution higher, and hopefully that 185 target one will get met. General Motors on the other side of the equation is in a bearish environment at the moment. It has moved below key support levels. It does kind of look a bit toppy. I know that there's many of you, I'm sure, watching this will understand that General Motors is of course a great company, but it is breaking down to the downside at the moment. I think for me to get bullish on General Motors, it would need to put in a failed breakdown. What I essentially would look at it as is it's really what I would call an oops, where you get the failed breakdown and then a rip higher. That's generally how I look at those kind of charts, and it is something that I will actively be watching for with General Motors. I like good companies like most of us, and I would pay attention if this was to resolve higher. Roblox, on the other hand, massive downtrend. There was hope yesterday actually that we would get a resolution higher, but it looks like the breakout has just immediately failed. It's one of the reasons why I like to wait for a continuation day or a follow through day, and I don't like to buy intraday breakouts most of the time. For this particular example, there is no PE ratio on Roblox. It's of course a speculative metaverse name that I put out some really bearish charts on this one around 6 weeks ago, and it was a massive winner to the downside. But like I said, I'm always looking for reversals in trends, and it looks like Roblox has potentially failed that test. I covered United States copper and the copper miners a few weeks ago, essentially just saying that if you are looking to take a position in copper, then these are levels to certainly pay attention to. I did also put these charts out to Twitter on the 17th of May. But what I wanted to highlight is if you are looking for copper and you want to invest in copper, it's quite often very wise to understand that if you are, let's say you're weighing up to buy the copper ETF or the copper miners, the charts are essentially the same, but one chart gives you 40% upside and the other chart gives you 20% upside. Now this is of course what I'm paid to do. So with the copper miners, that's really the chart that you would look to buy. I hope that would make sense to everybody. But certainly, with the copper miners, the Freeport McMorans, and you would hope that the upside objectives are met. We know that with trading ranges, it's very, very straightforward. You buy at the bottom, you sell at the top, and you get out if it breaks lower. It's really, really that simple. We've got FedEx holding up very, very well. The concern I have is with rising fuel costs, etc. FedEx obviously being in the game of deliveries and freight, couriers, etc. The more times a level is tested, the more likely it is to break. So there is a potential that it could break lower, but at the moment it is a chart that I think probably favours longs to the upside, just for the risk to reward proposition. And if it breaks lower, of course, get out of town. I think Tesla, that 550 level could come into play. I think with Elon Musk, I think he has announced a freeze on hiring at Tesla, brought the stock under pressure today. So potentially 550 could be a level that I might look to buy some Tesla. Nike, covered this one a few weeks ago. Again, massive reversal from very logical support levels. The stock is up 17-18% since I covered it, so congrats to anybody that was watching my last analysis. Bristol Myers Squibb, now this is quite interesting to me at the moment because we are potentially looking at breaking out of a massive base dating back 20 odd years. So I think if this can resolve higher and start to kind of break out above $80, then I think Bristol Myers and Squibb could be one of those. As we can see, it's a massive cup and handle pattern for those of you that like those chart patterns. So I'd be looking to pay attention to that. I covered the Palantir last week for our clients, just highlighting a potential bottom, and if it was to move back up above its October 2020 IPO levels. I think one thing I do understand is with gaps, quite often gaps get filled and then they continue lower. So for me, I think if Palantir can kind of get above, if it can get above that 975 level, I think Palantir could get quite interesting. Same with OLN. Again, I'm using Fibonacci extensions levels. We can see that the chart has merit. I think if it's above $65, I don't see what the problem is with being long at the moment. Target, again, covered this one for our clients last week whilst I was on vacation, just highlighting the captain obvious that an oversold bounce was very, very likely. That's exactly what we've had. So we'll see how this one continues to play out, but I am anticipating some kind of meaningful bounce here. But it's one of those environments with the market at the moment that it just would not surprise me if it just the stock continues to crater lower. But quite often the warning signals are already there. Especially when we get failed breakouts. Then we resolve lower, then it puts in a bearish retest, and then before you know it, the stock's on its way down. And then as soon as a downtrend starts, you should always expect negative earnings and negative earnings reactions. It's just how the market works. The market's forward looking, so people that are in the know are already starting to dump their shares before earnings, and of course that's exactly what happens. We've got Dick's Sporting Goods again. Fibonacci retracement has pulled back 61% of this entire move and found support at a logical support level. We've got DR Horton above $65. What's not to like? I put this chart out to one of our clients on the 18th of April. He requested a chart for DR Horton. Just basically highlighting $65 as the level to buy it. That's exactly what's happened. We've got a breakout in EOG resources as well. Of course, it comes back to the oil and gas names, and looks like it's breaking out now. Before I go any further, hit the like button. If you're still sticking around here, it tells me that you're getting a lot of value from my work. If you hit that like button, it really aids me with the YouTube algorithm, etc, etc. Now, if you are wondering, I guess, who it is I am, if you've just stumbled across my work for the very first time, my name's Sam. I run honeystocks.com charting service, and with charting, I'll walk you through exactly what it is that we provide. But I know that with the market, it's really a case of what have you done for me lately. And I think with my track record of making big market calls, if we go back to January, obviously calling for big valuation reset. This is one of our free blogs back in November, highlighting the failed breakout in the small caps, which is where this whole decline started. Failed breakout watch on the S&P 500 again on the 5th of January, just highlighting that 2 months ago IWM put in a failed breakout, and we saw how that worked out. Now, this enabled many of our clients and members to start to take defensive action before all this carnage started. And if you want to go further back, I will link at the end of this video the analysis that was provided to our clients and members in the week running up to the 2020 crash, which I think, of course, it was incredibly stressful. Managed to get the majority of our clients and members defensive ahead of that. But what we provide with our memberships is a premium weekend analysis. So every weekend I provide a premium analysis with updated charts to all of our clients and members across the world. We provide access to high conviction trade ideas. I also provide a midweek halftime analysis. I provide access to a wonderful trading community. Got 250 members all across the world. Provide charting support on a daily basis. So if you are somebody that maybe doesn't have a lot of confidence and would like to a second opinion on a chart, then I'm available during market hours and generally have a response time of a couple of hours. So if you need a chart, I'm on hand to provide my own. And if you are somebody that is looking to learn technical analysis, I used to charge a lot of money for this, but now I just include it as part of our membership offering. Full access to our complete technical analysis program. And of course, the reviews are very, very good on that as well. A lot of our clients and members are very, very happy with that. So, this is what our trade alerts look like. This is a recent alert that went out for Micron Technology. Williams, COS went out. Cloudflare, massive winner. Square Inc, massive winner. Zscaler, massive winner. And of course, that's Antero Resources way back at $10. I think I touched on that one a short time ago. But I am very, very unique in what I do because I'm very, very transparent about the stocks that I recommend to our clients and members. All of our high conviction ideas are listed on our website. So if you are somebody that is considering our memberships, then of course, make sure that the types of stocks that I like to recommend are the types of stocks that you like to buy. I provide updates twice a week to all high conviction alerts, and I have done this over the last 4 years, so feel free to go and check that out. But I think we are a good fit for anyone that has a mid-term approach. If you are a minute day trader, scalper, absolutely do not come anywhere near my service. I couldn't think of anything worse than providing charts on minute time frames. So I think if you've got a mid-term approach, longer term approach, maybe you've got that investing mindset, I think it's probably a good fit. If you're looking to get away from day trading, I think if you are looking to learn technical analysis, or maybe you just want to be part of a community and you're sick and tired of hunting around social media and following everybody's Twitter feeds, etc., and all the YouTube videos out there. And if you're just looking to have access daily to a professional analyst, then it's all there for you. But what I would say is that with my work, full 7-day risk-free trial, so there's no risk there. Refunds, no questions asked. So I think, certainly if you look at testimonials on my website, these are just a few. I think Dan trades options, but certainly that's obviously a massive performance. It's not usual. I would probably say that's ridiculous, but that's the power of options. We've got Sean, looking forward to many more years as an investor and member. Nick, member for life. Rocco, great year, loves the community and of course the education side of things. Vince, another massive year, 100%, plus individual performances just from, of course, options, etc., and individual performances. So there's a lot to it. Feel free to go and check out our website and do all your own due diligence. But if you've stuck around to the bitter end here, don't forget to hit that like button. But hopefully can welcome you soon. Thanks very much for watching.